Picture this. You bought your house 3 years ago with a 5-year fixed-rate mortgage at 2%. Your monthly payments are £950. Life is good. Then your fixed rate ends, and you're automatically moved onto your lender's standard variable rate of 7.5%. Your monthly payments? They just jump to £1,450. That's an extra £500 every single month, £6,000 a year, £30,000 over the next 5 years. Sound familiar? Here's the brutal truth. Millions of UK homeowners are about to face this exact scenario. Their fixed-rate mortgages are ending in 2026, and they're going to be hit with payment increases of £300, £800 per month. But here's the good news. You don't have to accept that. Remortgaging, switching to a better deal, can save you tens of thousands. In the next 13 minutes, I'm going to show you exactly what remortgaging is, when you should do it, the step-by-step process, and the 5 mistakes that cost UK homeowners thousands. Let's get into it. All right, so what exactly is remortgaging? Simply put, remortgaging means switching your mortgage deal, either to a different product with your current lender or to a completely different lender. Why would you do this? Reason 1. Your fixed rate is ending. Most fixed-rate mortgages last 2, 5, or 10 years. When that period ends, you're moved onto your lender's standard variable rate SVR, which is usually much higher. Right now, the average SVR in the UK is around 7 to 8%. If you were paying 3% fixed, that's a massive jump. Reason 2. Interest rates have fallen. If market rates have dropped since you got your mortgage, you can lock in a lower rate and save money. Reason 3. You want to release equity. Maybe your house has gone up in value and you want to borrow against that increase, to fund home improvements, help your kids get on the property ladder, or consolidate debt. Reason 4. You want to change mortgage type. Maybe you want to switch from a tracker to a fixed rate for certainty. Or maybe you want to overpay more aggressively. Now here's the key point. Remortgaging isn't just for people whose fixed rates are ending. Even if you're still in your fixed period, you might be able to switch, though you'll usually pay an early repayment charge. But for most people, the trigger is simple. Your fixed rate is about to end, and you need to act. So when should you remortgage? Here are the main scenarios. Scenario 1. Your fixed rate is ending in 3 to 6 months. This is the most common reason. Most lenders let you lock in a new deal up to 6 months before your current deal ends. Why 6 months? Because mortgage rates can change quickly. If you lock in a good rate now, you're protected even if rates rise before your current deal ends. Scenario 2. Interest rates have dropped significantly. If you're on a tracker mortgage and rates have fallen, you might want to lock in a fixed rate to protect yourself from future rises. Or if you're already on a fixed rate but rates have dropped below yours, you could switch, though you'll need to factor in any early repayment charges. Scenario 3. Your home has increased in value. If your house is now worth significantly more than when you bought it, your loan-to-value LTV ratio has improved. Lower LTV = better rates. For example, if you bought with a 90% LTV mortgage but your LTV is now 75% because of house price growth, you qualify for much better rates. Scenario 4. You want to make major changes, consolidate high-interest debt into your mortgage if rates are lower, release equity for home improvements, switch from interest-only to repayment mortgage, add or remove someone from the mortgage. Scenario 5. You're unhappy with your current lender. Poor customer service, limited flexibility, better deals elsewhere. If you're not happy, you can switch. Now here's the critical question. Should you stay with your current lender or switch to a new one? Let me break down both options. So should you stay with your current lender or switch to a new one? Option 1. Product transfer stay with current lender. This is the simplest option. Your current lender offers you a new deal and you stay with them. Pros: no legal fees usually, no valuation needed usually. Faster process, 2-4 weeks less paperwork. Cons: you only see your current lender's deals. They might not offer you their best rates, limited choice. Option 2. Remortgage to a new lender switch. You switch your mortgage to a completely different lender. Pros: access to the whole market. Potentially better rates and deals. More flexibility over payments, portability, etc. Cons: legal fees £1,000, £2,000, valuation fees £0, £1,500, longer process 6-8 weeks, more paperwork. Early repayment charges on your current mortgage if still in fixed period. Let's say you can save £200 per month by switching lenders. That's £2,400 per year, £12,000 over 5 years. But switching costs and legal fees, £1,500. Valuation, £500. Early repayment charge if applicable, £2,000. Total cost, £4,000. So your net savings over 5 years, £12,000. £4,000 equals sign £8,000. That's still £8,000 in your pocket. But here's the thing, you need to do the math for your specific situation. And that's where a mortgage broker comes in. For most people, I recommend using a mortgage broker. They can compare deals from the whole market and find you the best option, whether that's staying with your current lender or switching. Most brokers are free paid by the lender, so there's no downside. Now let's talk about the actual process. Alright, so how do you actually remortgage? Here's the step-by-step process. Step 1. Check your current mortgage details. Before you do anything, find out, when does your current deal end? What's your current interest rate? What's the early repayment charge ERC if you leave early? What's your current LTV? How much do you owe in total? You can find this on your mortgage statement or by calling your lender. Step 2. Check your credit score. We covered this in depth in the credit score video, but it's worth repeating. Your credit score is critical. If your score has improved since you got your mortgage, you'll qualify for better rates. If it's dropped, you need to fix it before you apply. Check your score on Experian, ClearScore, or Credit Karma. Step 3. Work out your equity. How much is your house worth now? Use sites like Zoopla or Rightmove to get an estimate. Then calculate your LTV. Current mortgage balance, current house value 100 equals sign LTV%. For example, £180,000 mortgage, £250,000 house value equals sign 72% LTV. The lower your LTV, the better rates you'll get. Step 4. Get agreement in principle AIP. Just like when you bought your house, get an AIP from your current lender and 2 to 3 other lenders. This shows you what you can borrow and at what rate. Use a mortgage broker. They can get AIPs from multiple lenders quickly. Step 5. Compare deals. This is where the real work happens. Compare interest rates, the obvious one, fees, arrangement fees, booking fees, valuation fees, legal fees, early repayment charges if you need to break your current deal. Overpayment allowances, can you overpay without penalty? Portability, can you take the mortgage with you if you move? Offset facilities, can you link savings to reduce interest? The cheapest looking deal might not be the cheapest overall once you factor in fees. Use a mortgage comparison tool or broker to see the true cost. Step 6. Apply for the new mortgage. Once you've chosen your deal, formally apply. You'll need to provide proof of identity, proof of address, proof of income, recent payslips, P60, bank statements, details of your current mortgage, details of the property. Step 7. Property valuation. The new lender will value your property to confirm it's worth what you say. This is usually free or low-cost £0, £0 500. Step 8. Legal work and completion. If you're switching lenders, you need a solicitor to handle the legal transfer. This takes 4 to 6 weeks. If you're doing a product transfer with your current lender, it's usually much simpler and faster 2-4 weeks. And that's it. You're remortgaged. Your new deal starts, and hopefully you're saving hundreds per month. But before you rush off to apply, let me show you the different types of remortgage deals available. Alright, so what types of remortgage deals are available? Type 1. Fixed rate remortgage. Lock in your interest rate for 2, 5, or 10 years. Your payments stay the same, no matter what happens to market rates. Pros: certainty, predictability. Cons: if rates fall, you're stuck paying more. Early repayment charges if you want to leave early. This is the most popular choice for remortgaging because it gives you certainty for the next few years. Type 2. Tracker remortgage. Your rate tracks the Bank of England base rate, usually at base rate plus a set percentage. Pros: if base rates fall, your payments fall. Cons: if base rates rise, your payments rise. This can be good if you think rates will fall in the next 2 to 3 years. Type 3. Discount remortgage. You get a discount off the lender's standard variable rate for a set period. Pros: lower initial payments. Cons: SVR can change at the lender's discretion, less predictable. Type 4. Offset remortgage. Link your savings to your mortgage. You only pay interest on the difference. Example: £180,000 mortgage, £20,000 savings, =, you only pay interest on £160,000. Pros: reduces interest paid, flexible access to savings. Cons: usually only available with larger deposits, rates can be higher. For most people remortgaging, a 2-year or 5-year fixed-rate deal is the safest choice. It gives you certainty while you figure out your next move. After the fixed period ends, you'll face the same decision again: remortgage or move to SVR. But here's the thing: not everyone qualifies for the best deals. If your situation has changed, job loss, reduced income, credit issues, you might face challenges. That's why it's critical to check your eligibility before you apply. Right. Before you remortgage, I need to warn you about the 5 biggest mistakes that cost UK homeowners thousands. Mistake number 1: waiting until your fixed rate has already ended. I can't stress this enough. Start the remortgage process 3 to 6 months before your fixed rate ends. If you wait until you're already on the SVR, every month you delay costs you hundreds in extra interest. Mistake number 2: not checking for early repayment charges. If you're still in your fixed period and want to switch, you'll likely pay an early repayment charge (ERC). These can be 1 to 5% of your remaining mortgage balance. On a £180,000 mortgage, that's £1,800, £9,000. Factor this into your calculations. Sometimes it's still worth switching, sometimes it's not. Mistake number 3: only looking at the interest rate. The cheapest looking rate might not be the cheapest overall. A deal with a 4.5% rate but £2,000 in fees might cost more than a 4.8% rate with no fees. Always calculate the total cost over the deal period, not just the monthly payment. Mistake number 4: not improving your credit score first. If your credit score has dropped since you got your mortgage, you'll get worse rates. Spend 3 to 6 months improving your score before you apply. It can make a massive difference. Mistake number 5: not using a mortgage broker. I know it's tempting to go direct to your bank, but you're limiting yourself to one lender's deals. A good broker can compare the whole market and find you a better deal, often for free. The difference between a 4.5% rate and a 5% rate on a £180,000 mortgage over 25 years is over £25,000. Don't leave that kind of money on the table. Avoid these 5 mistakes and you'll save yourself thousands. Alright, so how long does the remortgage process take? Product transfer stay with current lender, 2 to 4 weeks. Switching to new lender, 6 to 8 weeks. If complications arise, valuation issues, legal delays, 8-12 weeks. So if your fixed rate ends in 6 months, you have plenty of time. Start the process 3 to 4 months before your deal ends, and you'll have your new deal locked in before the old one expires. No gap, no SVR, no stress. Right, so here's your action plan to remortgage and save thousands. Step 1. Check your current mortgage details. Find out when your deal ends, what your rate is, and what ERCs apply. Step 2. Check your credit score. Sign up for Experian, ClearScore, or Credit Karma. If your score is below 620, spend 3 to 6 months improving it. Step 3. Calculate your equity. Use Zoopla or Rightmove to estimate your house value. Calculate your LTV. Step 4. Get agreement in principle. Speak to a mortgage broker. Get AIPs from 3 to 4 lenders to see what you qualify for. Step 5. Compare deals. Look at interest rates, fees, ERCs, overpayment allowances, and flexibility. Step 6. Apply and complete. Choose your deal, apply, and complete the legal work. Aim to have your new deal start the day your old one ends. If you follow this plan, you could save £200, £500 per month. That's £2,400, £6,000 per year. £12,000, £30,000 over 5 years. That's real money. That's a holiday. That's your kids' university fund. That's your retirement. If this video helped you, please subscribe. Every week I'm putting out videos exactly like this one. UK-specific money advice that actually works. Hit the bell too, so you don't miss the next one. And when you're ready, this video right here, about credit scores, is a great next watch, because your credit score is critical to getting a good remortgage rate. Thanks so much for watching. I'll see you in the next one.